An EIUL stands for Equity Index Universal Life Insurance Policy. And it's a type of permanent life insurance policy, just structured a little bit differently than normally. Normally, it gets structured for death benefit. I reverse that. I structure that so it builds up cash value inside of it. One of the questions that people have about EIULs is that, why haven't I heard about this? If it's such a great idea, you know, none of my friends know about it. It's a hard question to really answer for someone like me who's been dealing with it for 15 years. But I think when I really sat down and thought about it, it became somewhat obvious. People today, from the first day they walk into their new job, when they're bright and shiny young, what's the first thing that happens? They sit down with benefits and they start talking about, this is what you need to do to save for retirement. You need to get yourself a 401k and you're going to put some mutual funds in it, and that's going to get you to your retirement years. All you got to do is just keep putting it in there, keep putting it in there. No one ever questions it. No one ever says, well, is that really true? Is that really the best way to do that? What are the downsides to doing it that way? And so I just think that it's so crowded out by the pervasiveness of what Wall Street and the government's telling us to do. I have one for myself and I have one for my son. And in fact, I bought an EIUL before I even got involved in the business. And I had it for about 18 months before I started thinking, wow, I really like this. This is something I ought to offer to other people. And I went out and got my insurance license as a result of being a customer first. Universal Life really started in the 1970s. There was a stockbroker, a guy that owned a brokerage firm. He got together with a friend of his who ran an insurance company, and they developed the first universal life policy. The reason why he was interested in this was that he knew that you could put money in and then take it out tax-free. But he was unhappy with the old whole life policies because the rates of return inside those were 1% and 2%. And being a Wall Street guy, that was totally unacceptable to him and his clients. So he designed a product to where you can invest into the market and also get all these advantages of being able to take it out tax-free. Unfortunately for him, or fortunately for the rest of us, the IRS started taking a real hard look at this, and he took this to an extreme where they just have just a tiny bit of life insurance to go along with this huge amount of cash they're putting in. And so the IRS ruled a couple times in the 1980s and said, look, there's got to be a connection between the amount of life insurance and the premium that you put in there. And so they set up the rules that we now live by. So as long as we structure it correctly up front and you're within those rules, then the tax-free nature of the loans become viable for us. So the first thing is just taxes. When you take the money out, it's tax-free. It's not even a taxable event. The second thing is called sequence of return risk. And this is something that very few people are told about. Sequence of return risk is the risk that when you want to use that money, the market has had a big downdraft. It's gone down significantly right about the time you want to use it, right about the time you started using it. And you talk to anyone that tried to retire in the 2000s, they know exactly what you're talking about because it is so damaging to people's retirements. It destroys them. It forces them to work much longer than they can. And in fact, the 2000s, we had two of them, and people were never able to catch back up to where they were before. In an EIUL, you never have that negative number. You never have to worry about the market taking that big downdraft when you're about to use it, and it reduces the risk significantly. And so taxes on one hand, sequence of return risk on the other hand. Normally, you got your 401k with your mutual fund, you're going to pay income tax at whatever it is. It could be 25%. So if you avoid that 25% tax right off the bat, and if you happen to live in a state that has a state tax on top of that, it could be more than 35%. So right off the bat, if you can eliminate that, you can increase your savings by 35% and more. All life insurance policies, all permanent life insurance policies have two sides to it. There's the life insurance side, and then there's a savings component. They have to have that savings component so that you can afford to have insurance later on because these are made to keep forever. So pretend like you're an 85-year-old man, you have $1 million worth of insurance. If you were just paying for the $1 million insurance with no cash value inside of that, it would be almost $1 million because you're past your life expectancy. So you're building up cash inside of that. You have that savings component. But what I do is I try to build up that cash value even higher. I do that by keeping the death benefit down as low as the IRS rules allows me to do that, and so that you have the cash value being built up higher and higher so that when you're ready to use it, you can take the money out of the policy and there'll be a lot of it in there to take out. An EIUL is totally flexible. We can structure it to whatever financial situation you find yourself in, whether you want to pay premium for a short period of time, and the shortest period of time would be 4 years and a day, or you want to pay premium all the way up to the day you retire, or something in between. Whether you want to take money out, say, 15 years after you started, or if you're going to wait all the way to retirement, which could be 30 or 35 years down the line, or if you just want to put it in there and just see what happens. You might not ever want to take it out, and it'll just build up in there, and you can present it to your heirs in a tax-free manner for the most part. So it's very flexible. It's tailored toward whatever situation you find yourself into. I think it is safer, certainly more conservative, because you're not actually investing in the market. You're getting a index-like return, but it's an interest you're getting. And the actual investor is the insurance company backing the policy. And so in that way, you don't have all that market risk. Money you put in as premium into the Equity Index Universal Life grows, but you have to remember you're not investing within the market. Okay. What's happening is that you're getting an interest credit based on the movement of a group of stock indexes with certain limitations. Those limitations are very simple. 0%. If the stock indexes go negative, you get a 0%. And that's one of the keys to understanding why this works so well, is you're never taking negative numbers, and negative numbers are more harmful than positive numbers are good. And so you're eliminating all those negatives. The second thing, in most of the options, you have several options. Most of the options have a cap rate. 17%, one of my favorite options. So each year you're going to get somewhere between 0% and 17% added into your account. And then that's in there permanently. It cannot be taken away. It's like a stepping stone. Boom, boom, boom. Never goes negative. And then there is now, some of the options are uncapped. And so you get whatever the top end is, but you always have that 0% on the floor. And it's two key things. You're not investing in the market. It's the insurance company that's backing it, that's doing the investing. And the second thing is you never get a negative number. One of the questions that people always have about EIULs is, how do I get money out of it? What's that mechanism? And so it's the mechanism that's called a loan against your death benefit. And it's what makes it tax-free. But most importantly, it's been upgraded with the EIUL. So there's a couple different types of loan you can take. One works pretty straightforward. It's called a fixed rate loan. So you have $1 million in there. You want to take $100,000 and put it into your pocket. Then you have $900,000 left, and you'll get your interest credit on that remaining $900,000, and they charge you 0.1% or $100 for the $100,000 that's in your pocket. So that's more or less called a wash loan, even though they charge you $100. It's more of an administration fee. The second way, and the way I prefer and I suggest, is called a variable rate loan. And there's one called the index loan on my favorite policy, which is the Minnesota Life policy. That does it a little bit differently. Same $1 million in there, same $100,000 in your pocket, but here you're going to get the interest credit on the full $1 million, even though you got $100,000 of it in your pocket. But you're going to get charged 5%. So if you were to get a 0% year, which is the worst you could possibly do in those, it would cost you $5,000 for that. But let's say you got a 10% year on the returns and the interest. There you're actually making $5,000 in the money that's already in your pocket. And looking at historic numbers, you'll see you have a 2 to 3% advantage of doing that way over longer periods of time. So that's the way I think is the most preferable way of doing it. When you're doing retirement income planning, or just financial planning in general, there's a couple clear things you need to think about. The first is you need to have a variety of ways of getting income in retirement. And so the EIUL gives you a second or a third bucket that you can take money out. And it allows you the flexibility to take it out whenever you want to. You don't have to wait till you're 65 or 59 and a half. You're not forced to take it out if you leave it in there for long periods of time during retirement. It gives you the total flexibility to take it when you need it or leave it in there when you don't want it. And there's no penalties for taking it out, like in an IRA or a 401k or anything like that. And then on top of that, when you take it out, the IRS has already ruled that it's a non-taxable event, so there's no taxes on it. So you can interplay it with your other ways of getting cash out in retirement income. Perhaps it's real estate or some other way. You might need it to fund other opportunities, for example, or you might not need it and just leave it in there, or you might decide, hey, in retirement I'm going to take my family around the world, this great around the world trip. You just take the money out of there. Maybe you have an opportunity that comes up and you say, I need $50,000 and I can't get it from here, but you can always get it out of your EIUL. So the flexibility to get money when you want it and not have to worry about taxes. Tax efficiency is critical. And if you go into retirement with your typical 401k, you're going to be paying state income taxes as well as federal income taxes that can be 35% or more, depending on your tax rate and what state you live in. And by eliminating taxes from at least one pot, you've done yourself a great service and you guaranteed yourself at least 35% more for that pot than you would have if you have to pay taxes on it. A lot of people that we talk to about EIULs think, wow, this is great. Where's the catch? There is no catch. There are risks though. Like any financial instrument, it has risk. And it's more of a general risk. It's the risk of overall worldwide depression that the insurance companies that can't invest and get a decent enough return and therefore can't pass that on to you. There's that risk. Of course, if that happens, then there's not going to be any safe harbors for investing or putting your money or even burying it in your backyard, right? And the second one is really you. But as long as you hold this for 15 years or so, you'll be fine. You're not going to get involved in EIUL unless you're thinking long term. This is something that's called permanent life insurance for a reason, something you're going to keep for your life. And so just because the expenses are front loaded doesn't mean that's a lot of expenses, because once you start actually using it, there's almost zero expenses coming out. So when you really look at EIULs over your lifetime, depending on the age that you start one and your gender and when you start taking out money, it could be anywhere from, say, 0.1%, which is pretty cheap, or around 1.8% or so if you're older when you start one. Still really reasonable, especially when you compare it to the tax savings you're going to get at the end of the day. So you're paying 1.8%, but yet you're saving 25% on the taxes.